Cost Accounting, Chapter 19. In Chapter 19, we're going to talk about investment centers and the evaluation of investment centers. So if you remember in Chapter 18, we talked about the responsibility centers that were cost centers, profit centers, and revenue centers. And investment centers are the fourth type of responsibility unit. In an investment center, the manager has more control than in a profit center. So they're similar to profit centers, except the manager also has control in the level of invested capital. So we control revenues and costs and the amount of invested capital. So we look at the level of invested capital as part of their performance evaluation. And if they transfer goods or services with other internal units, then we also use transfer prices, which we're going to talk about at the end of this chapter. So we're going to talk about various performance measures that we use for investment centers throughout chapter 19. And of course, why do we create financial performance measures? Well, they're used to motivate. We want them to achieve better things for the company. So we create incentives for them, whether through bonuses or salary raises, extra vacation, or other perks in order to make sure that they're meeting the strategic goals of the company and helping their division have better performance. Main ways that we look at evaluating performance, the short-term financial performance, are return on investment, residual income, and economic value added. So first we look at return on investment. This is the most common measure that we use for investment centers. The higher this amount, the better financial performance. This is calculated as the return on sales times the asset turnover. That's also called the DuPont method of calculation. So profit divided by sales times sales divided by our average assets. We should make sure that we're using how we're defining profit or investment in determining ROI is consistent, whether we are using net income or operating margin or contribution margin, or how we're defining what profit we're looking at, controllable profit versus total profit. The two components that are return on sales or the profit margin, so a firm's profit per sales dollar, which measures the manager's ability to control expenses, and the asset turnover ratio, which is the amount of dollar sales achieved per dollar of investment. Next, we're going to look at an example for return on investment. So we have a computer company. They sell computer software and books. They have 3 locations. The company's profits declined in the Midwest last year, and so we're going to look at their operating results and ROI calculations. We have computers, software, and books. We have the income, the average assets invested, and their amount of sales. So we look at the return on sales, the asset turnover, and the ROI. So we can see that the ROI on computers dropped significantly from 2018 to 2019, but increased on software and held steady for books. Overall, our return on investment has fallen. This is mainly due in the decline of the return on sales, and this is most highest in the computer unit, as we saw. Software is the most profitable of the 3 units. Things that we need to consider when we're using return on investment to evaluate the performance of investment centers are: 1, the depreciation policy. So the determination of our useful life and depreciation method affects income and the amount of our average investment. So larger depreciation charges reduce the return on investment. We also need to think of our capitalization policy. So this is when an item is expensed or capitalized as an asset. So an expensed item reduces the numerator of ROI and a capitalized item reduces the denominator. And there are various calculations for how we can look at that. We also need to consider the inventory measurement methods. So our choice of inventory cost flows affects our income and our reported inventory values, which are investment, are also affected. Full costing creates a bias on income and therefore on return on investment. So remember, when inventory levels are higher, that our net income is greater under full costing, and where we write our variances off to. So are we closing them to the cost of goods account, or are we prorating them? Because that has a direct effect on our income and inventory balances. Which assets do we include in the return on investment calculation? So is it all assets, total assets? Is it only long-term assets? Is it only controllable assets? Do we also include intangibles? And how do we measure our investment? So how do we share things? If we have shared assets, such as these areas of computers and software and books are all in the same exact building, how do we allocate what percentage of that asset is being used by which area? So that amount of investment, we normally look at the historic cost of the assets as they're being carried on our books. This is the book value of the current assets plus the net book value of the long-lived assets. So the net book value is our historical cost, of course, less accumulated depreciation. However, if long-term assets are the largest part of our total investment, historic cost doesn't reflect our current market value. So a relatively small historical cost value can overstate the return on investment. So if we have an organization that has, if one of our divisions has older assets, older building, their investment is going to be much smaller than a division that we've opened in the last year. So we can measure them in a multiple of different ways. One of them is net book value, which is the historical acquisition cost less the accumulated depreciation. Gross book value is the historic cost without the reduction for depreciation. Replacement cost is the current cost to replace the assets. And then the liquidation value is the price they could be received from their sale. We're going to look at the three regions now. So we look at the net book value, the gross book value, the replacement cost, and the liquidation value. And we can see what the measurement of those four values, how it affects their return on investment. So if we use the traditional net book value of historical cost minus depreciation, we see that the Boston region has the highest return on investment. However, if we move down and look at replacement cost value or gross book value or even liquidation value, in all three of those measurements, South Florida has the highest return on investment. Remember that return on investment data can be skewed, and so it's important to not use this as the only performance measure. So some of the problems with return on investment we already saw is is the value of the company shown in that with different inconsistencies with what we use for the numerator or the denominator causes ROI to swiftly change, and it creates disincentives for new investments. So if I'm a manager and my bonus is determined based on my ability to grow return on investment, I'm not going to take on new investments that could lower my personal division's ROI, even if that investment would be beneficial to the organization as a whole. So that creates a goal congruence problem because I'm making decisions that benefit me personally and my bonus personally based on the incentive system that's been set up instead of making decisions about the organization as a whole. So the summary of return on investment, limitations, and advantages. So it's easily understood, it's fairly easy to calculate, and it's one of the most used measurements and also reported by business media. Limitations are it creates goal congruence issues, and comparability across investment centers can be problematic because of difference in measurement, as we saw in these examples. In the next video, we're going to talk about a couple of other performance measures that can help deal with some of these limitations of the return on investment measurement.